Welcome to today's video, The Silent Battle, Why Your Insurance Claim Will Be Lowballed. We'll uncover why insurers minimize payouts, how to make a strong demand, and how to leverage appraisals and escalate smartly. We will also include a clear disclaimer and give you actionable frameworks and tools. Now, let's begin by previewing what we'll cover. In this agenda, we'll start by breaking down why lowball offers are common. Next, we will clarify the difference between establishing liability and securing a fair payout. Then, we will build a powerful demand, discuss the reality of independent appraisals, and map escalation pathways. After that, we will calculate your bottom line and practice quick negotiation scripts, followed by a couple of quizzes. Let's transition to an overview of the silent battle you're in. Once an insurer accepts liability, many people assume a fair payout follows automatically. In reality, acknowledgement of liability is just the start. Insurers routinely minimize their payment obligations, and the first lowball offer is designed to anchor your expectations and create fatigue. Your leverage begins with a formal, professional demand that sets the record and the number. With that context set, let's add a quick but important disclaimer before we continue. This content is educational only and not legal advice. Insurance and consumer protection laws vary by jurisdiction, and your facts may differ materially. Consult a qualified attorney or licensed professional for advice about your specific claim. With that said, let's move into why lowball offers are so common so you can plan your strategy accordingly. Lowball offers persist because the insurer's incentives prioritize minimizing payouts. Common tactics include anchoring a low first offer, encouraging claimant fatigue through delays and repeated document requests, and exploiting information asymmetry regarding valuation methods. They may also focus on minor discrepancies to distract from the core claim value. This flowchart shows how a low anchor leads to fatigue and acceptance for some, while those who push back move into escalation and improved outcomes. Next, let's distinguish between liability and payment. Establishing liability means the insurer agrees they owe you something, not necessarily a fair amount. Negotiation is what secures the money. You should go first with a number justified by evidence, not opinions. Enter every negotiation with a predetermined bottom line so you are not swayed by anchors. Now that we've framed the problem, let's construct a powerful demand to set your anchor properly. To build a compelling demand, first, state liability clearly and reference the claim number and key dates. Second, itemize all damages and attach or link documentation. Third, if applicable, present a diminished-value rationale and method. Fourth, set a firm demand amount and a deadline. Fifth, include independent appraisals when available. Sixth, pre-commit to your next escalation if the demand is not met by the deadline. Finally, keep your tone professional and evidence-driven. With your demand set, let's explore your escalation pathways in case the response is a lowball. This mind map centers on the lowball offer and fans out into escalation options. Internal appeal and supervisor escalation are typically low cost and quick, requiring a clean documentation packet. The appraisal clause or independent appraisal may increase leverage but cost money and time. A regulator or Department of Insurance complaint can pressure compliance with timelines and fair claims practices. Small claims court offers a venue for modest disputes, with filing fees but clear deadlines. Attorney involvement on contingency can be appropriate when damages justify the fee and legal complexities exist. Mediation or arbitration may be available depending on contract terms and can produce faster resolutions. Choose the path that matches your documentation strength, deadlines, and budget. Next, let's unpack the reality of independent appraisals. Independent appraisals can cost around $600 up front. Many expect them to guarantee a higher payout, but insurers may ignore even high-quality reports. A common tactic is to return with an offer around $1,700 regardless of report detail, aiming to induce fatigue. Accordingly, treat the appraisal as leverage for escalation rather than a guaranteed endpoint. With that in mind, let's compare the strengths of your report versus the tactics behind a low offer. On the left, a strong independent appraisal provides an evidence-based valuation with documented methodology, photos, comparable data, and a clear rationale. It strengthens your anchoring position and provides credibility if regulators or a court later review the file. On the right, the lowball offer relies on anchoring psychology, delay, and fatigue. It may nitpick minor issues, omit key comparables, and bet you will not escalate. Understanding both sides helps you plan your next move. Next, we will calculate your bottom line so you know when to hold or fold. This table models how to calculate a bottom line. Start with your claimed diminished value and other property damages. Subtract hard costs like appraisal fees and estimated time or travel. The expected net minimum is the point below which accepting a settlement undermines your objectives. Your numbers will differ. The key is deciding your walkaway point before negotiations. With a bottom line in hand, let's add quick negotiation scripts you can adapt. Here are adaptable negotiation lines. For the phone opener, acknowledge accepted liability and restate your evidence, demand amount, and deadline while pre-committing to your next step. When countering a lowball, reference specific omissions in their analysis and renew your deadline. For the deadline follow-up, restate the timeline and the escalation you will take if the deadline passes. Now let's test your understanding with a quick quiz. Question: if the insurer accepts liability, what should you do first to avoid a lowball trap? Options: A. Wait for their first offer so you know their position. B. Send a formal, evidence-backed demand with your number and deadline. C. Argue immediately about small line item discrepancies. D. Purchase an appraisal and assume they must pay it. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to send a formal, evidence-backed demand with your number and deadline. This establishes your anchor and timeline and prevents the insurer from dictating the negotiating frame with a lowball offer. Next, let's move to a second question focusing on appraisals. Question: you paid $600 for an independent appraisal and received a $1,700 offer anyway. What's the best next step? Options: A. Accept the $1,700 because the report failed. B. Send a polite email thanking them and restart from scratch. C. Use the report as leverage to escalate per your pre-stated plan. D. Abandon the claim to avoid more hassle. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to use the report as leverage to escalate per your pre-stated plan. The appraisal's power comes from how you use it to trigger pressure points, not from expecting it to compel a fair payment by itself. Next, let's provide a ready-to-use demand template you can adapt. Here is a copy and paste demand letter template in Markdown. It includes claim identifiers, an itemized damages section with exhibits, a valuation basis section outlining methodology and comparable data, and a clear deadline with pre-committed escalation. Customize amounts, dates, and the next step to fit your case. Now let's summarize the most important points to remember. These are the key takeaways. Liability opens the door, but negotiation determines your payment. Lead with a professional, evidence-backed demand with a firm deadline. Treat any appraisal as leverage rather than a guarantee. Avoid getting trapped in minor detail arguments and be ready to escalate. Finally, decide your bottom line before you send your first demand. Next, let's visualize the journey from incident to resolution with a simple timeline. This timeline shows a practical rhythm. Quickly gather evidence after the incident. Draft and send your demand shortly after liability acceptance. Respond to a lowball by countering with specifics, and escalate promptly when deadlines pass. Following a timeline keeps momentum on your side. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If this helped you, please like the video, share it with someone who needs it, and subscribe for more strategies. Tell us your toughest negotiation moment in the comments and what you want us to cover next. See you in the next video.